Federal Reserve announced some important changes in the way it thinks about setting interest rates. In the past, what we had seen is the Federal Reserve will start to raise interest rates and slow the economy if they think that inflation is going to approach 2%, which is their target. The problem with that is they ended up slowing the economy before we ever really sustained 2%, and it meant that inflation was on average below their target. Their new policy is designed to ensure that inflation averages 2%, which means they're going to tolerate a period of above 2% inflation in their outlook before there will be pressure to raise interest rates. Add it all up, and it means that not only is the Federal Reserve saying no rate hikes this year or next year, but in fact, they're trying to extend that case all the way to 2024, where they'll wait until at least that long before seeing the need to raise interest rates. What that means for investors now, even if it ends up being that they raise rates a year earlier than that, is that not only are short-term interest rates very low in both the US and Canada, but actually longer-term interest rates are also really low as well. That actually poses a major challenge for investors who typically would have split some of their money between riskier assets like stocks and safer assets, and particularly the safest asset, government bonds. The problem right now is government bonds are really nothing much better than cash. They yield less than expected inflation, even if you lock away money for 10 years. And so the hazard here is that to earn a decent rate of return over the next decade on your portfolio, you're going to have to make some fairly tricky choices. One option is to have less of your money in those safe assets. That puts more money at risk, potentially giving you a better long-term return, but at the cost of greater volatility from year to year. Investors who aren't comfortable with that, I think, are going to face another tough decision, which is it will mean that you're going to have a lower average annual expected return over the coming decade. And to meet your retirement goals, simply put, you'll have to be saving more of your money in the here and now. That may be something that for Canadians who have escaped the wrath of the COVID recession is now achievable. The reality is that we are seeing many Canadians saving more of their income now than they did prior to this crisis, not because they really wouldn't want to spend or they've made this calculation about retirement, but rather we're being prevented from spending on many things we would have done before. We're afraid to fly in many cases. We're not taking the expensive vacations. We're not going to live theaters and concerts. And that's leaving more money set aside for savings. And so the accident of history is that we're in a period of time in which Canadians are indeed saving more of their money. And because interest rates are so low, and therefore investment returns, at least the safest investment returns, are so low, that might just give us enough money being set aside to make those retirement obligations that we have down the road. One of the other consequences of very low interest rates is that as investors try to shift their money to things other than bonds, they start to bid up the prices of other assets. So that explains one reason why the stock market managed to do as well as it has done, given the sorry state of the economy. It also goes a long way to explain why real estate prices have remained fairly elevated in the middle of an extremely high period of unemployment. But I caution that that may not be forever. We have the makings of a bit of a slowing in the housing market here in Canada. We have fewer immigrants coming. That's part of it. And they may have been renters, but they are depleting then the demand for rental properties. So I'd be cautious about extrapolating what we've seen in recent real estate prices, particularly for rental properties, into the future. It also is showing up in the valuations of other assets. It means that stocks that pay a steady dividend, for example, have been bid up in price, and therefore, again, perhaps not as much of an expected return if you buy today. So the problem of low interest rates implying low returns on bonds also extends to other assets now that they have been bid up in price by investors moving out of the low fixed rate environment that we're seeing in the bond market.